Hi everybody, this is Griffin Bridgers. It's my pleasure to introduce a presentation on estate tax liquidity, and we're going to dive into some of the issues that are related to estate tax liquidity and look at some solutions under Code Section 6166 and maybe an option known as a Graegin loan, and maybe dive into some of those nuances, but we're not going to go very deep with this. This is a very surface level presentation given the time we have here in this YouTube video. So I want to emphasize that what this presentation is all about and all of my content is about is more ideas than education. I want to leave you with ideas as to what are the solutions if you end up in a situation like this so that you have the tools to go and dig a little deeper. Now before we get into the presentation, I want to remind you that this is for educational purposes only, and this presentation is not intended to substitute for legal or tax advice or your own independent research. But that being said, what are we concerned about here? Well, with estate tax, it's rare anymore that it's actually paid, because the estate tax for an individual only kicks in at a rate of 40% to the extent your taxable estate exceeds a threshold of $12,060,000 for 2022. But that amount could go down by 1/2 with inflation adjustments between now and then, as early as January 1 of 2026, and maybe even sooner if changed by Congress. So you have to have enough cash within your estate to pay the estate tax that's due, and oftentimes it's due within 9 months of date of death. Now, sometimes you can get an extension of time to pay when you can show disputes over the valuation of assets, but most of the time what you're going to end up with is this 9-month window of time to generate enough cash to pay the estate tax. And that can create issues when you have estates that don't have enough liquid assets to pay the estate tax that's due. Where there's substantial illiquid assets, you could run into a situation where you either have to do a fire sale of the assets for less than their fair market value, or at least the value determined for estate tax purposes, and or you may have to look at borrowing from an outside third party, possibly at unfavorable rates. And that could be coupled with possibly personal guarantees that have to be extended from the heirs who end up inheriting from the estate, whether it's in trust or individually, and that might be a bad outcome as well, especially if you have a business interest whose value is going to be substantially diminished economically by the loss of a key person, like we saw in the movie Tommy Boy, if you've seen that, which is a valuable movie for estate and gift tax and business succession planning when you look at it holistically. But we'll look at that another time. So that's a little preview of a treat I've got coming down the pike. But here's a quick example I want to give you for the liquidity issue and what it can cause. Where there's a fire sale required, it's important to note that estate tax is always based on the fair market value at the date of death. If you have to sell an asset at a discount to pay the estate tax, then you're still going to have to use the higher value as of date of death to calculate that estate tax. So essentially what that means is that whatever discount the buyer gets in the fire sale, you also have to pay estate tax on that discount as if it were an asset of the estate. And what that does is it increases the effective estate tax rate. Now, I'm going to use the term effective estate tax rate to illustrate this, because even though the top estate tax rate is 40%, it's important to note that that 12 million and change exemption drives down the total proportion of estate tax to the taxable estate itself. So in this case, we're going to look at and assume that we have a taxable estate that's valued at $20,060,000 and thus generates an estate tax of $3.2 million. Now, all things considered, the effective estate tax rate here would be 15.95%, which leaves a net of $16,860,000 going to heirs. But let's assume that to pay this estate tax of $3.2 million, you have to sell illiquid assets at a fire sale. Now, let's assume maybe that the assets are only sold for $16 million. They don't fetch the full $20,060,000 in the sale. So what that does is it increases that effective estate tax rate up to 20%. You're paying an estate tax not just on the 16 million sales price, but also the 40 million or the $4,060,000 discount that had to be taken in selling that asset. And that means, as a net, there's only 12,800,000 left for the heirs of the estate ultimately. Everybody gets much less money at the end of the day. That's a bad outcome. So how do you get around this? Well, one option is that there's a code section, 6166, that allows estate tax that's attributable to a closely held business interest to be deferred. It can be deferred up to 5 years and then paid in equal annual installments over up to a 10-year period. Now, this is good because if you have a closely held business interest that is generating income or cash, then this would allow you to spread the estate tax out over a period of time that might correlate to that cash flow from the business itself. But this isn't available to every closely held business interest. There are certain thresholds you have to have. First, at the ownership level within the business entity itself, not regarding the gross estate itself, but within the business entity itself, the decedent has to have had at least 20% ownership in that business entity. And counting the decedent and with some other look-through rules, there generally have to be 45 or fewer partners or shareholders or members in that business entity itself. Another thing you have to consider is that when you look at the adjusted gross estate, there's a valuation threshold that has to be exceeded, and that is 35% of the adjusted gross estate. So more than 35% of the adjusted gross estate has to be comprised of this business interest. And you calculate that, by taking out the economic deductions, things like interest, administration expenses, things like that. And we'll talk about interest in a second when we look at Graegin loans. But you also have to consider that 35% threshold after taking into account gifts that occur within 3 years of the decedent's death. So you can't just make deathbed transfers to drive down the value of your gross estate to meet this. You have to plan ahead enough, 3 years or more in advance if you want to gift to meet this threshold. Now, if you don't meet the threshold of 35%, with one business interest, you can aggregate multiple business interests with the caveat, again, that you have to have it held at least 20% ownership in each of those business entities. There has to have been at least 45 or fewer business owners. Now, as I reminded you above, you can only defer the estate tax that's attributable to the business interest here. You can't defer estate tax attributable to the remaining 65% or less of the adjusted gross estate. And the interest that's payable at the IRS rate for underpayments or deferrals of tax is due here as well. So during the 5 years that you're not paying anything, you still have to pay interest annually to the IRS. And once the estate tax installments kick in, you also have to pay interest on the deferred estate tax as well. So you're going to have very high interest in the beginning, and then it's going to slowly go down over the payment period, but that's still a bad outcome. So here's a quick illustration of code section 6166. As you can see at the bottom, we have a business entity. We have the decedent's estate and other owners, but total there have to be 45 or fewer owners. And the estate itself, or the decedent, which then their ownership transfers to their estate, has to have a 20% or greater equity interest in the business entity by capital and voting control as well. And then up in this bar at the top, we see that the ownership threshold for that business entity, in terms of the composition of the adjusted gross estate, has to equal by or exceed by value 35% of the adjusted gross estate. And only the estate tax that's attributable to that portion can be deferred. So if you say, let's say you own 36%, or you own an interest that comprises 36% of your adjusted gross estate. So that's what meets your threshold there. And we assume you have the 20% equity interest as well, or greater. But if you have the adjusted gross estate made up of 36% of through business entity interest, then you can only essentially defer 36% of the estate tax that's due and payable. But that aside, you aren't always going to qualify for that installment payment of estate taxes. Whether or not you do, another option you can consider, as we talked about at the beginning, is that you can take a loan from a third party for payment of those estate taxes. And that's where we get into an option known as a Graegin loan, and I'll mention the nuances as to what makes a Graegin loan in a minute. But for the time being, you pretty much can always take a loan from an outside party or even a related party to pay the estate tax that's due and payable over time. But anytime you borrow money, there's going to be a cost to doing so in the form of interest. So that interest, when paid, will have to be or may be able to be deducted by the estate or the successor heirs who take on the liability of that loan. And then the recipient of that interest has to include that interest in their gross income as ordinary income. So the catch of the Graegin loan is the determination of whether the interest that's payable by the estate itself is deductible. Now, there's a lot of nuance and depth to this question of whether or not that interest is indeed deductible. So we're really going to take a 30,000-foot view here. You really have to do your research on this before determining if you can answer the simple question of whether the interest is deductible. But I want to note that you can't double dip. You either have to deduct interest on the 1041 for the estate or trust, which ends up with that liability, which means you're getting that interest deduction against income that's generated within the estate or trust. Or, alternatively, you could deduct interest on the estate tax return, Form 706. Now, the benefit of the 706 versus the 1041 is that the 1041, you can only deduct interest on an annual basis. Whereas with the 706, you can look ahead to all interest that will be payable over the life of the loan and deduct it in full today without discounting for present value either. So that's a really great benefit if you can get it, especially with a longer term loan with higher interest. That's a substantial interest payment you're going to pay amortized over the life of the loan, which can really give you a great deduction up front on the 706. And ironically, drives down the amount of the taxable estate and the estate tax that is payable ultimately as well. Now, in either case, there's a storied history, especially on the 706 deduction, as to whether or not interest is deductible. Now, Graegin was a tax court case where they dug into this a bit more, so I'd encourage you to go read that. And while this list is not all-inclusive, here's some common requirements from not just the Graegin case, but other cases on point here and other IRS rulings that have come down the pike. And these are really just kind of the high points to keep in mind. One, if the loan is from an interested party, maybe a closely held business that the estate owns, you have to possibly come up with a substantial, valid, non-tax reason for the loan, which ironically here, you're really making the loan for payment of estate tax, which makes it look like the only reason for doing this is tax purposes. So that's a complicating factor, especially if you're borrowing in-house, because the IRS tends to look with, I wouldn't say disfavor, but I'd say a certain amount of skepticism on intra-family loans because it's assumed that the parties aren't acting at arm's length and won't be as motivated to collect on the loan or actually charge or collect interest, which is going to come into play in a minute. Another issue you have to look at is the need for the loan self-generated? In other words, if you created a family partnership and it's that family partnership itself that generated the liquidity issue, then you may not be able to deduct the interest that's attributable to a loan used to pay estate tax generated by that family partnership. Another thing to keep in mind is that if you want to deduct the present and future interest on the 706, there has to be certainty that that interest will be paid. So what that means is that there has to be a prepayment penalty within the loan itself. So in other words, that interest has to be payable in full no matter what. And it's common when writing loans nowadays, especially intrafamily or even unrelated party loans, that there's no penalty for prepayment of principal. But you have to go outside that and go against the grain here and actually have a penalty and say no matter what, even if you accelerate the payment on this note, you're still going to have to pay the full amount of interest amortized over time that would have been payable had you just paid according to the originally contemplated amortization schedule. And then finally, the loan has to have a substantial likelihood of repayment. So that digs into some of those related party versus unrelated party principles we looked at with a valid non-tax reason, but there's some things you can do here, and while it's not an absolute requirement, security for the loan tends to be good. So if you have a secured loan, that tends to go a lot further towards increasing that certainty of repayment than it would if you had an unsecured loan. Although with an unsecured loan, you may have grounds to charge a higher interest rate and get better bang for your buck. So you don't absolutely have to have security or a secured loan, but it helps. And it also helps if you have outside third parties who might demand repayment. And that doesn't mean you have to go to the bank and borrow the money in order to have a Graegin loan for which interest is deductible. That helps, but what this means is that, for example, if you had a business entity with enough cash to extend this loan, and that business entity had outside shareholders, which was the case in Graegin, then it's more likely that those outside third parties would look at their business entity holding and say, hey, a huge chunk of this entity value is made up now of a loan that was extended to this estate. We want to make sure it's paid back. So in that case, that strengthens the likelihood that that loan would be repaid over time. Finally, I'd be remiss if I didn't mention the alternate valuation date. Now, we're not going to dive into this in great detail. I think it's valuable to think of in this context as well when you're exploring liquidity planning. And what the alternate valuation date is, in a nutshell, is the option to value all of the estate assets, not as of date of death, but instead as of a date that is 6 months after the date of death. Now, in order to qualify to use this, then what you have to have is a reduction in both the gross estate and the estate tax payable. Now, it seems intuitive that the two would move in lockstep, but that's not always the case. For example, if you had a marital deduction, then that might reduce the estate tax that's payable traditionally. But if you're reducing the value of the assets that are eligible for that marital deduction, it's going to shrink that deduction and consequentially possibly increase the estate tax that's payable. So these two don't always move in lockstep. But that aside, you also need to note that the reduction in the value of an asset that occurs naturally with the passage of time won't be taken into account in determining this 6 months after date of death alternate valuation. Also, you need to note that if an asset in question is sold within that 6-month period for a price that's greater than the alternate valuation date value, then you have to use that sales price. So, lots of ideas to think of when it comes to estate tax liquidity planning here, and there's a lot I could get into with life insurance and other strategies, but that's more of a subject for another time. But as always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But thank you again for listening to this presentation. I look forward to seeing you in my future content.